Harry Dent, stocks have rallied this year, but you're of course not buying into it. Tell me why.
Well, long term, the Fed is fighting the aging of the baby boomers, which is a very predictable trend, and $42 trillion in debt, private debt that started to deleverage in 2008. To me, they can't win this war over time, but I tell you, the Fed just got a gift. This flight of capital from Europe caused Treasury bond yields to go down below 2% just when we had strong fourth quarter growth, which we predicted months ago. We said fourth quarter, first quarter is going to be strong, inflation's going to stay up. I thought that would put a brake on QE3. With this lower rates, the markets are saying, go ahead, QE3. So I do think we're going to slow later this year. I think QE2 is going to wear off on a one-year lag, just like QE1 did. But I think this time the Fed's going to stop in. You get QE3. So we get a mini crash. We get a rally into year end, probably to new highs. And then I'm more worried about the markets in 2014 and 13 and 14 because baby boomer trends are just going to keep working against this recovery. It's not a sustainable thing.
So we get QE3 later this year. Now, does the fact that it's an election year matter? Of course, they say that the markets do well in the year before election years, but are we going to get some more money because this is an election year?
Yeah, in general, election years aren't bad. I mean, they're going to make the economy look as good as possible. Now, last year I would have thought, yeah, but the Fed's running out of bullets because, again, we expected an expansion of the economy short term. And I said, well, you can't do QE3 when that's happening. But now, again, with these low rates, I think they will. So I think it matters some. And but we see from 2012 to 14, this is kind of the crisis time. This is when the baby boomers switch from what we call the kind of peak and plateau phase of spending. They actually start declining into retirement.
And how does one invest in this demographic period that you're looking at?
Very carefully. I mean, it's a bubble boom. We've had three bubbles. You know, 95 to 99, 2002 to 7, and now 2009 into 2012. Bubbles burst. I don't think this bubble's ready to burst yet at this point. You know, it's hard to judge a bubble, but you have to be investing in funds that don't correlate with the market. You have to have a point of view of, look, the more the market goes up here, the more I take off the table because the downside's way greater than the upside in a bubble. And if we do see a crash, say in 2013 or 14, that's when you can buy again. So you got to go opposite the trends because this is a sideways gyrating market.
So finally, we've been talking about the United States and our demographic problem. Pretty much Europe is ahead of us when it comes to that demographic problem. So what about the emerging markets? Everyone says that this is going to be the century of China. Yeah. So is that the place to be, or are they going to run into their own headwinds because they've overbuilt?
Well, China's overbuilt dramatically. China's been moving people from rural to urban areas where you triple their income, so it's a good formula for growth. But they've been overbuilding to do that. All these people come in rurals, they're building homes, they're building infrastructures, they're building factories and stuff that they're not even using. 24% of homes are vacant. Whole cities like Ordos, 1 million, totally vacant. So China's got its own bubble. And I think when we slow down, they have a hard landing, and then about a decade from now, the emerging world comes back stronger than ever, but China will not be as strong. China is the one emerging country where their workforce is going to be shrinking like Japan and Europe. India, Southeast Asia are the places I'd want to invest after a crash.